Title: Navigating the Green Horizon: The Influence of Environmental Factors, including Climate Change, on Long-Term Investment Strategies. Introduction. In the evolving landscape of global finance, environmental factors have emerged as pivotal forces shaping the trajectory of long-term investment strategies. Chief among these factors is the specter of climate change, an issue that transcends scientific discourse to profoundly impact economies, industries, and the investment landscape. This article delves into the multifaceted relationship between environmental considerations, particularly climate change, and the formulation of resilient, forward-thinking long-term investment strategies. The climate change imperative. Climate change, fueled by human activities and characterized by rising temperatures, extreme weather events, and shifting ecosystems, has catapulted to the forefront of global concerns. Beyond its ecological ramifications, climate change exerts far-reaching implications on businesses, markets, and investment opportunities. Investors are increasingly recognizing the imperative of integrating environmental considerations into their long-term strategies. Acknowledging the material risks and opportunities embedded in a world grappling with a changing climate. Mitigating risks and seizing opportunities. Environmental factors, and climate change in particular, pose both risks and opportunities for investors. On the risk front, companies operating in industries vulnerable to climate-related disruptions, such as agriculture, energy, and insurance, face heightened challenges. Physical risks, such as damage to infrastructure from extreme weather events, and transition risks, arising from shifts in policies and regulations aimed at mitigating climate change, underscore the importance of assessing climate-related vulnerabilities in long-term investment planning. Conversely, the transition to a low-carbon economy presents a fertile ground for investment opportunities. Companies leading the charge in renewable energy, sustainable technologies, and resource-efficient practices are poised to thrive in a world increasingly prioritizing environmental stewardship. Long-term investors attuned to these shifts can strategically position their portfolios to capitalize on the growth potential inherent in sustainable and climate-resilient industries. Regulatory landscape and policy dynamics. Governments worldwide are responding to the climate crisis with regulatory frameworks and policies aimed at curbing emissions and fostering sustainability. Long-term investors must factor in the evolving regulatory landscape when crafting their strategies, as changes in environmental policies can significantly impact the financial performance of companies across various sectors. For instance, a government's commitment to renewable energy initiatives may bolster the prospects of clean energy companies, while stringent emission standards may pose challenges for carbon-intensive industries. Consider the automotive sector, where governments are increasingly incentivizing the development and adoption of electric vehicles, EVs, to combat air pollution and reduce carbon emissions. Long-term investors keen on anticipating these policy dynamics can position themselves ahead of industry shifts, aligning their portfolios with the global transition towards a more sustainable transportation ecosystem. Physical risks and resilience planning. The physical manifestations of climate change, from rising sea levels to more frequent and severe weather events, pose tangible risks to businesses and infrastructure. Long-term investors must scrutinize the climate resilience of their portfolios, assessing the susceptibility of companies to climate-related disruptions and their preparedness to navigate a changing environment. Real estate investments provide a poignant example of the intersection between climate change and physical risks. Properties in low-lying coastal areas may face increased exposure to flooding, impacting property values and potentially leading to financial losses for investors. Incorporating climate risk assessments into long-term investment strategies enables investors to identify and mitigate potential vulnerabilities, promoting a more resilient and sustainable portfolio. Social and stakeholder expectations. Environmental considerations are increasingly intertwined with social consciousness, shaping consumer preferences and influencing stakeholder expectations. Companies that prioritize sustainability, ethical practices, and environmental responsibility often garner greater support from consumers and investors alike. Long-term investors attuned to shifting societal values recognize that companies embracing environmental stewardship are not only better positioned to weather climate-related challenges, but are also more likely to secure long-term viability and shareholder trust. Consider the growing trend of environmental, social, and governance (ESG) investing, where investors factor in not only financial performance but also a company's broader impact on society and the environment. This holistic approach to investment aligns with the evolving expectations of stakeholders, signaling a departure from purely profit-driven motives to a more sustainable and responsible investment ethos. The importance of scenario analysis. As the impacts of climate change unfold, uncertainty prevails, making traditional forecasting challenging. Long-term investors are increasingly turning to scenario analysis, a method that involves assessing a range of possible future outcomes based on different climate and policy scenarios. By considering multiple plausible scenarios, investors can enhance their strategic planning, identifying potential risks and opportunities across various climate-related trajectories. For example, a long-term investor in the agricultural sector may conduct scenario analysis to evaluate the impact of changing climate patterns on crop yields, water availability, and supply chain resilience. By preparing for a spectrum of potential outcomes, investors can proactively adjust their portfolios, ensuring adaptability in the face of climate-related uncertainties. Conclusion. In the intricate dance of global finance, environmental factors, especially climate change, have emerged as transformative forces shaping long-term investment strategies. The imperative to mitigate risks, capitalize on opportunities, navigate regulatory landscapes, and align with societal expectations underscores the need for investors to integrate environmental considerations into their decision-making frameworks. As the world grapples with the challenges posed by a changing climate, the astute investor recognizes that environmental factors are not merely externalities but integral components of a comprehensive and resilient approach to long-term investment planning.